created a new challenge for lawyers, developers, and investors: how to clear the sale and resolution of distressed crypto assets. It's become an interesting new business arena. Stephen Pally from Brown Rudnick, who's now going to lead a discussion on that, with Deborah Kovsky, who's a partner at Troutman Pepper, Thomas Brazil, managing partner at 507 Capital, and Shobha Pillai, who's the co-chair of the data privacy and security practice at Jenner and Block. Please welcome Stephen and his panel. There it goes.
Well, that's a chair.
Good morning, everyone. My name is Steve Pally. I am co-chair of the digital assets practice at Brown Rudnick, based in Washington, D.C., and a disputes lawyer by training. Sitting next to me is Deborah Kovsky. She is a partner at Troutman Sanders. Deb has 20 years of experience representing debtors, creditors, and other stakeholders in bankruptcy and restructuring matters. And she regularly represents creditors in ad hoc committees. She's involved in the Celsius, BlockFi, and FTX bankruptcies, and I'm really pleased to have you as a speaker here today. Incredible experience for something that I think is and will be of interest for many folks involved in crypto. Sitting next to Deborah is Thomas Brazil. Thomas is co-founder and partner at 507 Capital. He's got extensive distressed investing experience. He's got some very impressive degrees, a master's in applied math from Columbia, BS and BA from NYU in math and economics. And although he is not a lawyer, both of his parents are bankruptcy lawyers. That's got to come in handy. Again, very happy to have Thomas here on the panel. Finally, we've got Shobha Pillai. Shobha is a partner at the Jenner and Block firm based in New York. Is that right?
I'm in Chicago.
In Chicago, pardon me. Based in Chicago. She's co-chair of the data privacy and cybersecurity practice. She is also a former, former assistant U.S. attorney, federal prosecutor. She's got years of experience with, she's got years of extensive trial experience. She also handles corporate investigations, national security matters, and perhaps of greatest interest to me, and what we'll hear about today, is Shobha was the examiner in the Celsius bankruptcy. So pleased to have you on the panel as well. I thought what we do, we only have 30 minutes, but I think we can cover a lot to sort of set the stage and make sure everybody is dealing with the same basic information. I thought I'd ask Deb if you can give us, in 2 minutes, a complete explanation of the U.S. bankruptcy process.
Oh, yeah, absolutely.
No problem.
Yes, thank you for giving me a very easy task here. So just to level set a little bit, Chapter 11, which is the only aspect of U.S. bankruptcy we're going to be really talking about today, it's a collective process. A company that is unable to pay all of its creditors can go into a proceeding. There's an automatic stay that puts a halt to all lawsuits, collection activities, et cetera. All of the creditors of the company are able to file claims in a very simple and streamlined way against the company. So you don't have to worry about hundreds of thousands of people filing lawsuits to try to get back the money that they're owed. The goal of a Chapter 11 case is to have a plan of reorganization that basically becomes a contract between the debtor and its creditors that governs how those creditors get paid. Now, unfortunately, most of the time in bankruptcy, because the debtor's insolvent when it goes in and is usually insolvent throughout the case, there's usually not enough money to pay all creditors in full. So there's going to be a haircut at the end of the day. Creditors get paid, and then the debtor either liquidates or reorganizes and moves on.
So when we talk about a bankruptcy claim, Thomas, I'm going to ask you, because you're in the business of buying and selling them, what is it exactly? Does it mean I have the right to get, let's talk about in crypto, do I have the right to get my property back? Do I have a cause of action, or what we'd say in lawyer speak, a shows in action? What is it? When you buy a claim, what are you buying?
Yeah, traditionally you're buying basically all rights of recovery on account of the claim. That's the way most of the contracts are written, if you have good lawyers like those on this panel. Traditionally, most firms are playing kind of for cash when they're buying claims, and especially bankruptcy trade claims, I guess, is what's just the big discussion in crypto, because these cases are explosions of bankruptcy trade claims compared to most dockets, where you might have a $10 billion case, and in that case, nine or 9.5 billion is financial debt, bonds and secured loans and things, and then 500 million will be basically creditor claims. What's different in these cases, all the crypto cases, are that the whole case are creditor claims. A vast majority are unsecured creditor claims, the trade claim So people are generally playing for cash. Sometimes people will play reorg equity for distressed firms. Generally, they'll buy early in the case and they'll buy around different events. Usually it'll be when the schedules come out, bankruptcy schedules, and then sometimes when plans are put out or when different big motions are won or lost. The pricing will change in the market, and people will either be bidding up or down based upon that.
So Deb, let's go back to you for a second. Say I was a customer at one of the exchanges that are now in bankruptcy. When do I have a claim? What does that mean?
So that means that when the debtor goes into bankruptcy, let's just use Celsius as an example. So Celsius filed for bankruptcy back in July, and the day that it filed, there were hundreds of thousands of customers of Celsius that still had crypto assets stuck on the platform. And basically, all of those people, not all of them, the majority of those people had what you'd call a claim. They have a debt that's owed to them by the debtor. It's not their stuff, not their assets anymore, not your keys, not your coin, really, really means it in bankruptcy. So the majority of customers of Celsius, of BlockFi, of some of these other entities that have filed for Chapter 11, when the company files, all they have is a right to repayment, and that's going to be a right to repayment with a haircut. And not just with a haircut, but going to BlockFi as an example. BlockFi filed in November, maybe at the nadir of crypto prices, like absolute rock bottom. And what they're looking to do, and what most of these cases are looking to do, is to dollarize people's claims on the petition date. So for example, if you had one Bitcoin on the BlockFi platform and it filed for bankruptcy in November, this price, I don't call it 15,000, 15,500. That's what your claim is against BlockFi. And it doesn't matter that we've seen $12,000 of appreciation in Bitcoin prices since then, more. It doesn't matter if Bitcoin goes absolutely to the moon. The claim is the dollar value on the petition date. And that's the claim. But gets a little bit worse, because that doesn't actually mean, oh, okay, fine, so I have a dollarized claim as of the petition date, so I'm going to get paid $15,500. No, that sort of sets your pro rata share of the pie, but we don't know yet how big the pie is going to be. So if there's only enough pie to feed everybody 50%, you're going to get 50% of your dollarized amount on the petition date, and that's generally the approach that most of these cases have been taking.
Well, I want to get to Shobha to hear about her role as an examiner, but this issue, you talk about dollarizing. Let's say I'm OG crypto and I started mining Bitcoin in 2011, and for some reason I forgot not your keys, not your crypto, and I have a bunch of money in an exchange. I don't want dollars. Why do I not get my crypto back? Do we have are there cases that are on this? Have judges started to rule on it? Or is there something in the bankruptcy code that addresses this?
Yeah, it's section 502B of the bankruptcy code says that a claim, if there's an objection or if there's any dispute about how a claim should be valued, and trust me, there's going to be disputes, those claims get valued as of the petition date in US dollars. Now, that doesn't mean that you necessarily get paid in US dollars. Maybe you'll get paid in, some small fraction of a Bitcoin, but you're only going to get paid as much of a Bitcoin as is worth what your pro rata share of your dollarized claim as of the petition date is.
What if are there tax consequences necessarily? I know we're not a panel on tax, but it seems like if I had Bitcoin and suddenly it's turned into dollars, is that something that is going to be addressed in the bankruptcy plan?
It's not something that the bankruptcy code can really help with. And caveat, I'm not a tax lawyer. I know almost enough to be dangerous, and I'll defer to Shobha if she knows more about this than I do. But my understanding from my tax partners, because we've been addressing this for clients in the various crypto cases, is that that's a taxable event. So if your basis in your Bitcoin, let's say you mined a Bitcoin or you bought a Bitcoin back when it was $250, and you end up in this bankruptcy situation and you get your claim, you get it paid, and you've got a dollarized amount, and that amount is fixed. You've basically been cashed out. You've got a taxable event there.
Sounds pretty miserable. So you know something about this, Shobha, the tax issue?
Nope.
Okay. Call your tax lawyers. This is not a tax panel. But I think it's important from an issue spotting standpoint to recognize that, I think crypto is here to stay. Bitcoin is here to stay. We're in for some rough sledding, but it's a risk to keep in mind when you have money somewhere else, money in crypto. You might not get your crypto back, you might get dollars, and there may be tax consequences. Shobha, I really want to hear about your role as the Celsius examiner. Talk about that, the appointment, and how did that also, you came from white collar, you were a prosecutor for many years. How were you appointed, and how was this sort of consistent with your prior experience as a prosecutor and trial lawyer?
Sure. So as I understand it, examiners are actually not that common in the bankruptcy courts. They come up when there's allegations of fraud and other risks of transparency within the bankruptcy matter, which was a significant issue in the Celsius matter. And the court's concern, as I understand it, was that ensuring that all parties, not just the unsecured creditors committee, had access to the facts relevant to the various claims, including Deb's clients, because Deb was represented in an ad hoc committee, not the unsecured creditors committee. There were also approximately 40 states investigating the attorney generals and various state regulators, along with almost every large federal regulator investigating the demise of this company. So the US trustee made a motion to the Southern District of New York Bankruptcy Court asking for an examiner to be appointed. So the US trustee, once that order, that motion was granted, interviewed, I think, 40 or 50 people trying to make a determination of who was the best fit for this particular matter. And so ultimately selected me. I think in part because I have a background in technology and cybersecurity and cybercrime related investigations, as well as national security related investigations. And I'm a former prosecutor, so I know how to investigate and find facts. I am not a crypto lawyer, and I'm not a bankruptcy lawyer. That might have actually been useful, even though I have some experience with the blockchain in doing digital asset-related criminal investigations. And so when I was appointed, the mandate was pretty narrow, and it kept expanding, in large part because the issues of fraud allegations and lack of transparency kept expanding, and there were issues being raised through the course of the bankruptcy that warranted a really thoughtful fact-finding process, which was what was our mandate. So we ultimately, at the request of the court, produced not one but two reports. The interim report actually addressed a lot of what Deb's clients were really interested in, which is the state of affairs as it related to the custody accounts, as opposed to the rewards earn accounts. And then the final report addressed pretty much everything else as it related to the allegations of fraud, the trading and washing, if you will, of the CEL token that was issued by Celsius, along with tax and crypto mining related issues.
Can I ask you, I want to do a little bit of follow-up. You made a distinction between custody and loan accounts, is that right? What was the difference between the accounts, and why was that significant to you?
Sure. So one of the things that happened in the course of the Celsius company was that in light of some of the regulatory scrutiny on the product, and this was, the slogan was unbank yourself, but it was really, I think, the new version of a bank or a crypto lender. That's how Celsius advertised itself. One of the concerns by some of the state regulators was that this was a security, which is an issue that comes up a lot in this arena. And so as a result, they had changed for folks that were not properly characterized within the US laws. They had to change and could not earn rewards on their crypto. So a regular Celsius customer, the advertisement was earn 18% rewards. Yes, 18%. That should have been a red flag. On your crypto if you deposit with us. And one of the fraud claims was Celsius said, don't worry, this is your crypto. We're just going to get you really great returns on your investment in the company. by engaging in really secure, low-risk investment strategies. Almost everything I just said turned out not to be true. But putting that aside, the idea was that if you could not, under the law, be somebody who earned those rewards in the US, your money was moved into what they called a custody account. So that happened on April 15th, 2022, which was before the bankruptcy in that matter. So the idea there was whoever couldn't have an earn account had a custody account, and everybody else had their earn account and were earning rewards. There was a lot happened in the spring of 22, as everyone here knows, but the devolution of the market impacted Celsius significantly. They did not publicly acknowledge that on a regular basis, said, we're fine, we have liquidity, we will be able to survive this. All of that turned out not to be true. I think you see a theme here. And in June, there was a significant run on the company. They lost upwards of $8 billion in assets under management in that couple months, $17 billion rather, in that couple months. So they paused withdrawals in mid-June and ultimately filed for bankruptcy in mid-July.
So what were your critical findings in the report? So give us a couple bullet points. And then I want to talk to Thomas about claim valuation and the impact of your findings on claim valuation.
Sure. So I think it's a lot of what I just said. There were allegations of fraud, as I mentioned, from across all the regulators at the federal and state level, as well as a lot of class action complaints from the customers. And so our job was to identify all of the facts relevant as a financial matter, as an employee statement matter. And one of the risks that we identified was there was no risk management, there was no documentation, they had no internal corporate controls, they had very little corporate governance. All things, it sort of doesn't matter what your product is, you kind of have to have, particularly if you're taking in customer money. So one of the examples is when you have customer money, you should write down like what every customer has. It's called an account ledger. They didn't really do that. They had billions of dollars in assets, $22 billion in assets under management at one point. They used QuickBooks for accounting, which I think is true for other companies of this size in the crypto market. Not a great plan. Their efforts to reconcile those account measures didn't actually occur on a regular basis, and if they did it manually. So their ability to actually know what assets, what coin they had at any given moment as it related to each customer massively failed. So for example, if I was a custody account holder and I knew I had 100 Bitcoin and that's what I invested and I had to move to a custody account, there was no guarantee they actually had my 100 Bitcoin anywhere. In large part because they kept swapping to stablecoin in order to manage some of the liquidity risks they were having as it related to some of their very high risk investments. So the fraud involved lying about the kind of investment risks. They claimed they had everything was over collateralized. That wasn't true. They claimed they had liquidity across the board. That wasn't true. One of the clear claims was that if you invest in Celsius, if we file for bankruptcy, you'll get your coin back. Clearly not true. Terms of service said the exact opposite. The amount of coin they had in management, almost never true. And then as it related to the cell token that they issued, pretty much the entire value of that cell token came from the market made by the Celsius employees. So the Celsius executives would often buy Celsius cell token from the company and then sell it back. So it was essentially being washed through the market, increasing the value, making it look like it had value. But it was a kind of a mirage, and then the rewards were being paid in cell token. So if you as a customer say, oh, I put my 100 Bitcoin in, I'm getting 18 cell tokens on the dollar for every single Bitcoin I put in. This is incredible, I'm getting so much value. Well, if the cell token is made up, it's magic beans, that's not actually gonna be value for you. You don't know that because the company that claimed to be transparent wasn't actually transparent because of all of the fraud, which is why somebody like me was hired or appointed by the court to investigate, because I think they wanted a clear statement of what the facts were. And so if you're not going to read, I don't think you need to read the 700 pages of my report. The first 30 in the executive summary explain everything I just said.
Can I just add something about Shoba's report? First of all, the report's publicly available. If you haven't read it, you should definitely pick it up. Just quoted on John Oliver, really good episode. You should check that out too. Shoba was quoted directly. But one of the really interesting things about the fact that there was an examiner and an examiner's report in this case is usually all of this stuff does not become public. Hey, Shoba, as the examiner, had incredible access to insiders, hours-long interviews with Alex Mashinsky, other executives, and all of this information was just put out there. Normally in a bankruptcy case, you'll have a creditors committee that undertakes that type of investigation. That's usually what I do in most of my practice, but it doesn't become public. That's not information that's available to people who might be interested in trading claims, trying to figure out what might the debt of this company actually be worth. So in a lot of cases, you're flying much more blind than you are in a case like Celsius, where so much information is becoming public. Same thing with FTX. You're seeing a lot of information coming out from John Ray that's being made very public that normally you wouldn't be seeing. So you have a lot more data points that you can rely on in terms of trying to figure out pricing and valuation. And I've represented claims traders before, I've represented claims sellers before. A lot of times you're really just, there's a real lack of information or asymmetrical information that results in a lot of mispricing. The other thing I wanted to point out, I had said before that claims get dollarized on the petition date, whatever your crypto is worth on the petition date. There are some exceptions, and the CEL token is one of them. In the Celsius case, I think the CEL tokens were worth something like 80 cents on the petition date. And the debtors are saying, no, that was an inflated fake price. So we're actually only going to treat them like they were worth 20 cents on the petition date. So if you thought you had a claim in bankruptcy, let's say you're a buyer of claims, and you think you're buying a claim in bankruptcy, I'm going to buy this person's CEL tokens, and they were worth 80 cents on the petition date. I think there's going to be about a 50-cent payoff. I'm making up these numbers, by the way, don't rely on them. And so I'm going to buy this claim for 30 cents on the dollar. All of a sudden, the debtor comes out and says, no. You thought this claim was going to get dollarized at its market value on the petition date. That was a manipulated value. We're going to reduce it down. Now you've bought a whole bunch of CEL tokens that are worth less than what you paid for them.
And the 20 cents was the value set at the ICO.
Yeah.
That's why.
So, Thomas, let me turn to you for a second. Sure. This goes directly to the question. Obviously, if you're in the distressed asset business and you're buying claims, you see a value. So how do you value, is the way you value crypto bankruptcy claims different than the way you value other bankruptcy claims? And what's in it for you? And a third question, if we have time, is what are the risks to sellers, to individual creditors?
Sure, that's a lot. Okay, first of all, the report was fantastic, and thank you for your service almost, to the estate. As large claimants in the estate, we love to see stuff like examiners' reports if they're needed. And I think accountability for the, hundreds of thousands of retail claim holders and owners is important. And for us, when we digest a report like that, we're trying to figure out, a big thing in bankruptcy is when the debtor actually became insolvent. Pre-petition, that has a lot of weight on, what kind of causes of action you can bring. And then, of course, within that, pre-petition behavior that might lead to causes of action, which can lead to recoveries for creditors. And if we're buying claims, that affects what we can pay in terms of price. On the 502B issue of dollarization, that's something that we have to explain to claimants, that their claims are dollarized. When you start talking about very alternative altcoins, we'll call it CEL tokens, FTT, things like that, it gets very hard to buy that stuff. There really isn't a market for it. What we try to do is if someone is a decent-sized seller, we try to come up with a more bespoke solution, maybe to include their FTT, but maybe they've got other assets within their claim that we can either buy a whole or partial claim, or maybe part where it's a loan and we're buying a claim against their company. So try to figure out good solutions for them, but it's very hard without legal precedent to be able to engage in transactions.
Let me ask you a question, and then maybe Deb, you can provide some color on this too. Anybody who reads the news knows that the SEC, the CFTC, everybody's cracking down on crypto. Does sort of the regulatory position in the United States, does that implicate how you value claims? Is that something that's holding this back, making claims?
I would say it makes, I would definitely. You have to take into the calculus when you think of, if you have a bunch of even venture capital investments within the estate. The estate of Celsius has some venture capital investments. FTX has a ton of venture capital. Three Arrows is nothing but venture capital. And so, it's all that's left after all the Bitcoin was gone from their lenders. You have to take into account, because what is the startup worth? If an NFT project is now illegal or something, it's not going to be worth the $5 million they paid for it, or
and
50.
Not just what is the startup worth, but you've got these entities in bankruptcy that are trying to find an exit. Right? That's how they're going to generate value. You know, they all filed for bankruptcy with multi-billion-dollar holes in their balance sheets. Customers' coins were not there. So how are people going to get a recovery? How are they going to get back some of their life savings that they put on Voyager or Celsius or you know, FTX? They've got to have some kind of a viable business on the other side. So you saw Voyager was trying to, well, Voyager first tried to sell to FTX. Obviously, that didn't work. Binance yesterday pulled out of the deal, citing regulatory concerns because the SEC and US regulation has made it impossible for these companies to reorganize in a way that's going to be regulatorily compliant. Maybe not impossible, that's too strong. Made it extraordinarily difficult, and that creates tremendous risk because if you're counting on a recovery on the other side coming from a new code that gets created that generates returns because the crypto's not there on the effective date of the plan to distribute out. You're going to get something back, and the rest of the value is going to come from whatever value this new code can generate. Well, can the new code be regulatorily compliant in the United States in this environment? I think that's a huge question mark and a huge risk, both for customers and creditors in the bankruptcies and for claims buyers.
Thomas, you got 18 seconds.
Yeah, just people don't, I don't know, it's like a misconception and distress. Like, companies are always worth more as a going concern than they are just purely liquidated. I mean, I know these are basically balance sheets, so you think, oh, just give me back my crypto. I mean, it's a bit more complicated than that because you need to work through some of these issues, but they're always worth more as a going concern, and the regulatory crackdown makes it very hard to get that going concern value.
Well, it looks like that's our time, folks. I don't want to wait for the hook to come out. I want to thank our panelists. I'm sure we'll be hanging around, so if you have questions, great pool of talent here. Feel free to stop by and say hello and ask your questions off the stage. Thanks very much.
Thanks, guys.